Hi, I'm Grant Mundell, investment specialist with Equity Trustees with our monthly market update for February. US stocks drove global equity markets high, yet again supported by megatech companies such as Nvidia and stronger than expected earnings. Remarkably, as at the end of February, the US S&P 500 has risen 16 out of the last 18 weeks, the first time in over 50 years. In local currency terms, the US S&P 500 jumped 5.2%. The MSCI World ex-Australia Index gained 3.8%, and the MSCI Asia Pacific ex-Japan Index rose 4%. The Australian equity market, or ASX 200, rose 0.8%, underperforming global markets. February hosts reporting season in Australia and offshore. Expectations were low going into reporting season in Australia, and overall company results were solid with more beats than misses. Cost management was a big focus, enabling companies to offset slowing revenue lines. And dividends reported also came in slightly better than expected. In the US, company results were strong, with earnings beats to misses of 4-1, broadly in line with historic levels. The best performing equity sectors in Australia included IT, consumer discretionary, and property. The property sector was fueled by Goodman Group's strong result and outlook, while retailers in the consumer discretionary space delivered better than expected results. On the flip side, lower iron ore prices weighed on the resources sector, while energy also underperformed. M&A announcements continued, with the building materials sector in particular in focus. Over recent times, Boral received a takeover bid from Seven Group. CSR was approached by European building materials company Saint-Gobain, and Adbri Limited received an offer from CRH and Barrow Group. Otherwise, bonds slipped as investors reacted to higher than expected inflation data out of the US. After betting as recently as December that the US central bank would cut interest rates 6 times in 2024, the market now expects only around 3 rate cuts. Locally, the RBA held rates steady at 4.35%. However, data is softening, with the unemployment rate ratcheting up to 4.1%, while inflation and retail sales data came in below expectations. Despite a reasonably robust reporting season, ASX 200 12-month forward consensus earnings were marginally revised down. Earnings in the Australian share market for FY24 are expected to fall around 5.5%, but then rise 3.9% in FY25. Valuations for the ASX 200, as measured by the price-earnings ratio, re-rated up to 16.4 times, a premium to the long-term average of 14.9 times. Global earnings expectations were broadly unchanged and are forecast to grow around 9% over the next 12 months, backed by growth in the major US tech names. However, the US equity market is also trading more expensive relative to historic valuation levels. While the risk of a major recession has reduced and central banks are likely to cut rates at some point over the next 12 to 18 months, we wouldn't be surprised to see the equity market take a breather in the short term. There are some elements of inflation remaining sticky, economic data is slowing, and valuations are fair to expensive. Despite this, many other asset classes are offering attractive income yields such as credit, fixed income, and cash. So the merits of a diversified portfolio should play out well over the balance of this year.